Hello guys, glad to have you on board again. Today, this is Monday, so we're going to do a weekly type of time frame, type of analysis, so swing time frames only. We're not doing any intraday stuff. I still don't restore the day-to-day analysis stuff because there's still not that much to talk about. Volatility still remains pretty low, though time is a variable in here, and this variable is moving pretty fucking slowly. So that doesn't mean there's nothing to say. It simply means that in order to have something to say on a day-to-day basis, I wish we have a little bit more volatility. Simply that. Not enough volatility to have new stuff to talk about on a day-to-day basis. So I would basically say the same old stuff all over again day after day. As these things are evolving in a pretty slow manner. So that's the reason why temporary hold is still maintained on the daily podcasts. But still, we're going to do the usual Wednesday educational podcasts. And this week, as it's been, I think, 3 weeks in a row that I basically didn't give you a choice about what the topics could be, so I decided it's about time to go back to the usual things. So a little bit of democracy in here. You guys will be able to pick the choice you prefer, and I'll deal with it on this Wednesday. So you've got the next 2 following days to vote into Discord. It's open for everyone, you know the deal. So anyway, you can get there. Normally I also dealt with all the script entry for TradingView. Remember that for an unlimited number of days, I mean starting now and at least leading to early 2020, the indicators are totally free for every fucking one to use. So you just now need to put a simple request. So like you get into the website, you get to sign up for the trial, and what back in those days were just a 3-week trial with a PayPal subscription. Now there's no such thing anymore. There's just a simple form. You put in an email address in which I can eventually reach out to only when it's necessary, and the users in here can testify I never send a fucking email. It's just in case, all right? I'm not phishing. I'm certainly not newsletter sending twice a week. I'm just never messaging you unless it's necessary. So anyway, now you just get to sign up. You give me your TradingView username, and I basically give you access within the next 24 hours, and you can use for free. So it's simple as that. You wanted to test, like I say, see for yourself. Now it's totally free, and instead of having just a week to try, you'll have at least a month. As I said, this thing will be on until at least early 2020, and on early 2020 I'll decide if I want to put the subscription back in place depending on volatility, which means if volatility remains freakingly low early 2020, I'll keep the system shut down, which means no daily analysis. And in that perspective, I certainly don't want you guys to pay for nothing in here, which means indicator will remain for free until we get some fucking volatility. That's basically the system we're into right now. So anyway, that being said, if I record this podcast today is because I've got new stuff to talk about. So let's get straight to the point. We're not going to deal with cryptocurrencies in here. So if you're a cryptocurrency fan or whatever, you know that I'm dealing with the weekly podcast on the TradingView platform. For some reasons. I mean, I want to stick to it. I think it's best with this way. So in here, we're just going to talk about stock market, forex markets, volatility-based stuff, and whatever. About what happened last week, what can we expect for the week to come out of what happened. So last week, it was interesting to look at the market. I told you about it. We had a little bit of volatility early in the week because very bad PMI numbers came in, sincerely suggesting that even with services, we might head for contraction within the next 2 quarters, and probably mostly within the first quarter of 2020. So if PMIs are contracting, it's hard for Wall Street to keep on climbing. But still, I mean, though a little bit of hesitation, we knew that there was some areas in which things could happen last week. They earlier reacted by these bad PMI numbers, and they were not just PMIs, and that was pretty much unexpected. on Friday, the NFP somehow came and flushed out everything because the number was astonishing. We went to new lows, 3.5%. On the global unemployment. So out of real numbers, it was an absolutely new numbers as the U6, remember that's the broad-based measurement of unemployment, which includes social categories that are not printed in to the big magical numbers of 3.5. Let me believe, if you believe that number, you're just an asshole. It's certainly not isn't the real unemployment number. The real unemployment number is closer to the U6, which is more like 7%, but even the U6 number just came to lower. So we're inching 0.1% lower on the broad-based unemployment measurements, which is compensated by a lower participation rate. With the participation rate dropped as well for 0.1%, which means basically it's not that great and that big of a job release number. Though the only thing that is astonishing is the number itself, the 266,000 job created, so it's really an astonishing number, certainly out of any expectation from analysts. So obviously this number had to readjust a lot of robotic systems and stuff like that. At least we don't nearly give a shit about what caused this. All we can tell is that this catalyst was big enough to fuck up the risk management last week, and that's obviously what happened. I tried a typical range trade in a range situation, and the number was so good that it instantly fucked up my stop loss, and that's absolutely normal. So I'm back into doing nothing until further notice, because I still believe we're in ranges, and let's have a look at this. So last week was a typical candle. These candles have a name in candlestick patterns. They're called shooting stars, so it means we're on the resisting area, like we're historical top trading right now. So we're dealing with possible resistant area, and the candlestick will significantly break the previous week's low and restore the gains at the end of the week, basically closing closer to the open price with a big breaking down lower shadow candle, which is exactly the typical structure for the shooting star. So shooting star is what we have. A shooting star pattern translates a typical behavior in the market, which basically means if you're dealing with a resistant area, it's likely going to build a range before reversing. So it's a type of psychological behavior that happens in here, totally somehow suggesting what I felt previously, that the market maker simply doesn't want anything to go wrong for the end of the week, for the next weeks, and though for the end of the year. We just want to settle down and have a cool end of this year, closing 2019, possibly at the market top or closer to it, so we can save the gains, and then we'll deal with 2020 when the time comes. So, like I said, I totally agree with that type of scenario. I totally understand it. The mood is currently into this, so the psychological behavior of the market is totally feeling that type of plan. Everyone wants to have a peace and quiet 2019 ending, not something pretty fucking volatile like we had in 2019. So the question is, will we be able to get something like that or not? Like I said, I think it all depends on whatever we'll have coming from unsustainable sources of information, which means the government, or Chinese, which means it's all about subjective things that could happen in the next 2 following weeks. We'll have less catalyst. We'll still have a big thing coming along next week, which is the new tariff round that will be put in place by the U.S. administration versus Chinese products. Is supposed to take place on the 15th of December. The Chinese officials have clearly been stating that if these things are put in motion, they will back off the deal, which means Trump administration wants to show some strength because they simply doesn't want to step down and show any signs of weaknesses to the market. So they probably will going to play bold as usual, which means they're going to say, we're going to put the numbers unless you get at the negotiation table. Though it's complicated, it's unable to be anticipated. So what's going to come out of this 15th of December area is freakingly complex. And all I can tell is that the market expectation accordingly to this are obviously volatility, which means normally we should have volatility ahead of this catalyst, but what we have on the charts is significantly showing the opposite, because last week simply suggests most of the probabilities are now heading toward a range in this nearby area. Because following those shooting stars, we generally get to do inside bars, and probably a couple of them, which means we're going to trade within the last week's range, most likely for the week to come, and likely as well for the week right after. So very likely, in a technical manner of reading this market, likely not going to move away from the nearby area before the end of this year, but we still have to deal with a very dangerous catalyst coming along next week, which is this tax round that's going to be showing up or not, depends on the US administration by the end of that year. So it's complex. Obviously, market makers are looking at whatever happens with this deal, how Chinese officials are communicating and stuff like that. It's totally unpredictable because there is no time scale and time frame for this. You don't know when the news is going to show up. We don't know which news is going to be dealt with, because so far we figured out that every positive news is very rapidly priced in by algorithms. Every bad news is somehow tempered pretty rapidly, and we rapidly fuck up volatility. So we'll see if that mood is still in motion, like bad news being neutral news and good news being extremely positive news. We'll see about that. It's still a complicated stuff to deal with. In the meantime, we'll still have to deal with other stuff, which is a little bit of numbers. There is still a Fed meeting coming along the way. So it's still a complex stuff to figure out. And in order to maintain this low volatility that the technicals are now suggesting, we need to have everything going along the way and fine, which means nothing must happen violently, everything must be smooth, predictable, and fine, which is still, for what I believe, very complex to achieve in the current context. So we're still facing the same old things. So in a weekly basis, we still have two major options. The first option is we just extended the bullish weekly cycle by a short-term breakout in here, and this is just a trap. We're just trying to go as close to the breakout target. Remember that sine wave in here is not plotting a breakout, but there is a breakout in here. Let me just show you this. Like, just go to my scripts. This is where you got the sine wave being visible. So as you can see in here, we did break. All right, there is a little breakout in here. It's just a little one. I don't even know if it's actually, normally we're supposed to dip below 50, and that's probably why it hasn't been detected. So as you can see, we've gone down to 55 or something like that. Let's just get to a more precise area. Yeah, we've gone 53, and normally we should dip below 50 to be considered a valid breakout point. So yeah, we're more in an intermediate type of breakout in here, which makes it complex to actually forecast. So I do believe that visually we do have a breakout attempt in here. The likely target will be 3,200, which means normally in here we're dealing with a bullish breakout attempt, all right? Bullish weekly breakout attempt on top of resistant context out of a mature trend that made its pullback, which means a freaking final excess context. So we might be dealing with the end of a trend on the weekly chart basis, which is my scenario. The other option is, remember that final excesses are professional only type of trading, because this is dealing with a reversal, and that doesn't necessarily end up this way. Sometimes trends get out of control and they start getting excessive. So can we have a market excess in Wall Street? There's everything we need for it. Market participants are extremely greedy and bullish. There is not that much bad news. There are a lot of bad forecasting news, but the actual real-time data still remains pretty solid. The PMIs are positive, showing narrowed but still expansion, we still have a pretty fucking solid job market, just like we saw, even though it's pretty complex because we have a very strong job market but no inflation, which is, I mean, we live in a magical world in which there's not enough workforce but we don't pay them more, so it's great. Like I said, I think it's a magical world in which we live in, and we're rapidly going to return to reality, but in the meantime we just can't know for sure, so it means we maintain speculative behaviors in those contexts. Don't get overexposed. Simply don't try to impose whatever you think to the market. The market will do whatever shit it wants. And for now, it means the market doesn't want to go down. It's trying to break up on a weekly context, which means if that's a success, we can go to new trends. Even though the trending behavior has already been done for quite a fucking while, this is where the breakout occurs in a weekly basis, which means we're very late stage trending. That doesn't nearly mean we have to reverse. And you really need to believe that, to understand that. We're mature, which means it's not about time to buy. Definitely not. We can't buy those breakouts because they're likely traps, but we can't nearly sell them with 100% confidence. So, speculative risk management, accept being wrong, try again if necessary, and all those things. All right? So for now and until further notice, we broke the weekly cycles, but the monthly cycle, which you see there, which is the monthly sine wave, is still on the bearish oscillation purposes. So if we fail, and if the weekly breakout we have is just an extension to fucking trap some bulls, and if the monthly setup just restore the normal behaviors, we should have a monthly bearish cycle. Normally a cycle is 10 to 12 bars, so we should have a bearish year along the way, because we should have 10 to 12 bearish bar oscillation in a monthly basis. That doesn't nearly mean it's going to last 12 months, it's just an average value in here, but the problem is one oscillation. Remember that one cycle is approximately between 20 to 30 approximate bars. So I take the 25 average for an entire cycle. So bullish oscillation and bearish oscillation. So a simple bearish oscillation is generally like halfway through it, which is normally 12 bars. But it is an average. And remember that what I told you is that generally these things are asymmetrical. Which means when we're in a trend, which we are, the overall trend was bullish, we generally spend more time into the bullish oscillation that we'll do into the bearish ones. So I don't expect 12 months of bearishness coming along the way, but most likely something like 6 to 8. What will happen during those months is complicated to forecast because we don't know how low we can go. All I can tell is that the nearest monthly supportive area, just switch to a monthly chart, we'll easily see that. These areas, we haven't been dealing with them anymore. So this is where we're likely going to go back. So this is where we're likely going to find some support. The most triggered area is where we left some volume, which is the 2500 area. I strongly think that this is where we're going to get to. We've got a 23% retracing area, which is setting itself in here out of 2570-80 area. And if we go there, this is where we're likely going to find some technical support on prices. Basically 23% retracement. This leaves us with a big area for those possible bearish monthly cycles. And like I said, that doesn't nearly set the ground for a bearish market crashing, whatever. It can just be a short-term pullback in the best case scenario, pulling back to 23% fib. And if the worst case shows up, which means the economy really deteriorating, like the job market sparkling, some problems and stuff like that, we might have to extend and likely going to break down to lower monthly support, which means if we fuck up this support, the next one is a little bit one in here, a tiny one in there, but it's a really tiny one. And if we have to get there in such short notice, just a few months, means a lot of volatility, means we're likely probably going to get to those supports and eventually try to slip below it, which gives us a first target area in here. All right, I think this target is likely going to be met by the early 2020 trading action, but if things goes out of control, we could reach out to this area as a second target. And just like that, all right, even if you think this is the end of the world, it clearly isn't. If you have a look at the overall economic cycle, we'll still be mostly profitable in there. because any fucking way would just barely retrace 50% of it, which is exactly what's been done out of the 20 cycle, of the 2000 cycle, basically gone up crazy and retraced 50%. What we're dealing with right now is that we could do it in a more spectacular manner, because I don't think we're going to go into an economical recession. I think what we can do is just fucking up some speculation problems that's been sparkling a lot of systematic issues into pricings, most likely because people think that there will be no problem. They hang on credits and derivative to cover positions, and that is a huge problem. That's exactly what was the 1987 problem, in which people thought derivative will save their assets, and it actually didn't, and sparkled a lot of volatility on the assets themselves. This is exactly what I believe right now. The problem is we're living into an automated world in which things are led to be thought as predictable. Remember what the fuck the market is, unpredictable by nature. So now people think they can predict. That's great. That generally means they're down of a false prediction corner, but we're still waiting for it to be proven right or wrong. And in the meantime, they're still being proven right, even though I still believe they will end up being proven wrong at a current given time, at a forthcoming given time. Right now, it's still speculating about that, just not following the DOMs is what I care. I think not buying right now is the only option. Patiently waiting for an eventual monthly bearish cycle to set itself. It must be quick, or it likely is going to be quick and violent and volatile. But for now, all we see is the opposite. Low volatility, breaking to new lows on VIX. And until we've got a clear sight of whatever the fuck happens with these things, we have to set back. That's really important for you to understand that. You can't be aggressive into such context, because what you forecast is not showing up on actual prices. And price is all that matter in here. Is what moves your account pricing and sizing. If you think you're going to be right, but actually be proven wrong with prices, the only outcome is that you're going to lose money, and we're not there for that purpose. All right, so making money is only done by risk-taking. I hope you understood that by now. The problem is right now you can't make money without taking huge amount of risks. Though I don't think it's about time to be greedy. I think it's more about time to be cautious and setting back, speculative trying some trades, but if they fail, you take the loss, move on, and stop if necessary. That's exactly what I'm doing. I've been trying more than enough. Now speculative losses have been piling on top of another, and I think I just burnt all my shots. It's simple as that. I tried my speculative entries. It failed too much times in a row. I just can't speculate anymore. I need to wait for an actual signal. This actual signal is the one I've been talking to you about. I need to have this weekly signal plotted on the charts. So far, I've got nothing. All I have is an overbought momentum. We might be reacting bearish in the nearby area, because I sincerely think we will, but so far we don't. I have no risk management structure in here. All right, so I've got no pattern on the momentum yet. And the other problem is, any fucking way, I still have no price reaction. We've seen last week that if we go down, it triggers a bearish signal, because we had a bearish signal last week. It wasn't closed, and the fact that the NFP was pretty great means we retraced it entirely and erased the weekly signal. So for now, and until further notice, well, I'm still waiting for this signal to show up, and as long as it doesn't, I can't do anything. So I'm going to wait. And like I said, technical suggests we're going to have inside bar, so low volatility and volatility contracting again by the end of this year, unless anything unexpected shows up and spark a little bit of uncontrolled volatility burst. And like I said, I think it's likely going to happen, but I can't just bet on this feeling, which means I need to see this right in front of me. Until then, I'm just monitoring things and waiting for something to happen. And if nothing happens, then I can't do nothing. The market has gone irrational in those contexts since that time. So can we go even more and even further into irrationality? Yes, because there's simply no limitation to irrational market behaviors, and we can go way beyond what's been done so far. I just, like I said, tend to believe that what we're doing here is not a trend breakout in here, but most likely a very ugly and volatile range, which can likely either end this way if everything is fine and if the Fed just acted as a support for asset prices, and basically instead of price contracting, the Fed just took it over to save the dips. And that's an option. Like I said, don't think it's not possible. I think the Fed can somehow force prices up and avoid prices going down into a temporary contraction of economical activity, but that can be just temporary. And if things just hold on good, I don't see any reason for us to go any lower than that. It's just, like I said, if things start to get out of control, if we have lack of visibility and stuff like that, that can spark a shit ton of volatility. And in that perspective, this will be the mid area of our range. And in that perspective, we'll likely dip below the 2500. That's the scenario I think is the most likely going to happen. That doesn't mean it will. All I can tell is that we're likely going to test this intermediate area starting from 2600 down to 2500, and how we'll react in there is entirely depending on whatever the economy will give us at the given time. Whatever is going to happen, I don't know. Just picture two different scenarios. The most bearish ones will be PMIs get to start getting into contraction area, like below 50. Just like it's been in Europe in some countries. So if we have the same in the US, how the fuck can we justify paying 15 or 16 times the benefits? We'll likely have to drop down significant amounts of profits into markets. That doesn't mean people will sell stocks. They're just profit take. You have to understand that. We're at the end of economic cycle. So the question is, do we expect more gains or should we take some dollars? That's simple as that. It's just an absolute way of thinking things. It's all about volatility. It's all about, do we have to go safe haven for a bit before buying cheaper stocks? So do we have to buy gold in the meantime, buy something else than dollars? Because remember that this is all about cycles. Let me just catch up on this. All right, so right now what we've had is the economy worldwide has been shifting. All right, so China has been the first one. Afterwards, we had the European economy who's been doing the same thing, and we're pretty much there nowadays. All right, we're starting to head down. China is starting to show some signs of bottoming, but people tend to believe that as China is bottoming, we'll all do this. All right, and US is doing like that. All right, US is just, all right, we're right at the top, and what US is imagining is that, all right, we priced in all the worst, so now the best, we'll get to price that in for everyone. Like China will go better, Europe will restore, will recover, and US will never have to draw down. That's exactly what US believe. Like, we're strong, Fed has been somehow saving us from going down, that's fine, and we still have plenty of room, and if things improve, we'll just get to price in better. What I believe is that anyway, what's going to happen is just we're shifting all those things, which means there is way more downside showing up, I think, in the euro area, just like I think the downside is just coming for Wall Street. So I've been using the same color in here, which made it pretty messy for you to understand. Let me just do it all over again with different colors, and you'll likely more. So this is what it goes. Right? Like, I'm talking about economic behaviors in here, not necessarily how the market behaves. So this will be China, most likely picking up 2 years ago and been contracting since then. And now we've got the euro area, which is just lagging. We've been picking up in 2017, 2017 most likely, early 2018 for the euro area. We've been picking up in here. So let's go back to our chart. All right, so let's assume this was 2015, 2018, or 2018 turn, right? And now we're here, 2019, and we've got the U.S. economy right at the best, right at the top, all right? And we see that the Chinese economy is downsizing. The Chinese economy is somehow bottoming up. And the thing is that, all right, consider this euro area and consider this USA, all right? USA. Come on. So it is USA. So the thing is that, like I said, people tend to believe that as China will recover, then US will rise. All right, like that we're just going to take the best out of everything. And in that perspective, this is what some market participants are thinking is the future. We're at the turning point. Two visions of the future. We're definitely there right now. All right, so we're standing into this area, which is, what do we do here? That's the question we ask ourselves right now as market participants. As China might be likely bottoming up in the following month, I think we're not going to go any way further with China. They're already down the corners. And I think anyway, the worst is already priced in there. So we might go a little bit lower, but not necessarily end of the world type of downward movements. But people do think that in an economical forecast, better things are down the corner for China. Personally, out of a monthly forecast, I think, yes, a few months from now, China is likely going to be in a better shape than it is right now. Not necessarily being fully productive to 10% growth and stuff like that, but like less worse than it is right now. And in that perspective, people think that it will likely improve the rest of the world just as accordingly. And in that perspective, US will never contract. And like I said, the tiny contraction we had in the euro area is the end. I doubt it. I think we have a little bit more of a downside, and I think there is just a lagging perspective of things. I don't nearly believe that the euro area will go as low as China, right? Like, I believe we're going to have an intermediate thing in which euro area will deteriorate a little bit more, and then when the momentum, global momentum, will set itself to be in a better shape, we'll eventually do this, just like I think we do have the same thing along the way for US, which means US, who thought the best will be down the corner, will have to suffer a little drawdown. I never said the US will enter a recession type of economy. I think the US will just likely show some bad numbers that weren't priced into asset prices. And in that perspective, we'll got to brutally readjust to reality, and then we'll see. But like I said, I don't think it's a recurring recessive process we're heading toward too. I think most likely we're heading into too much bullish expectations to be normalized in some way. Okay? So have a look at the volatility measurements. Just like we said, we've got a lot of problems down the corner. There's still too much passive investment in there, too much ETF equities and stuff like that, which means if it goes down, people will have to sell bulk parts of their investment, meaning instead of just selling one share of this company or whatever, they're going to have to sell numbers of shares of many companies, broad-based, world, sector-based, and stuff like that, which will create, I think, more impacting downside risks. But still, we have to. It still remains to be seen. In the meantime, gold is dealing with supportive areas. This was our likely previous resistance. How we deal with those areas is still complex to figure out, but we're dealing with supportive areas. If we find some support in there, we're likely going to go rise toward next areas. We're in breakout context, which means normally we should push toward resistance with a divergent type of structure, which means I sincerely believe that we dealt with this breakout area. We're likely going to get to this target, which is, I think, reaching out to the 1600 area, something like that, to push for a divergence, and then profit take, pull back, and eventually further profits to make next year if things tend to deteriorate even further. WTI still remains really hard to forecast, pretty much a bullish signal last week, but I doubt this is something you want to buy. At least I don't think it is. The problem in here is that WTI could be impacted by the economy keep on slowing down, but in the meantime we've got the dollar pricing in here that might be significantly impacting to the upside, because I still tend to believe that we need to have a close look at dollar next week, because what we have is showing signs of life in the dollar, and it has two options. Either we stick into that ugly endless range on euro dollar and we just hit the resistance once again in that big motherfucking trend channel, all right, and in that perspective in here we'll likely found a new resistance, all right, and instill that same perspective. Right, because currently, remember, that's how we deal with things. Normally, we're supposed to take this trend channel. Right, we're still somehow going up. It's still hesitating in here, but normally this is how was supposed to drive this thing. Oh, sorry, no, I'm doing shit. Damn it, I'm doing it the opposite way. So we're going up. So this is how you build your usual trend channels. All right, this would be like that. You take the lightest two supportive areas, you take it in here, all right, as it has to be the broadest possible channel. So this is what we're into. If we break out of these trends, all right, that's what I think we might be doing, but so far the NFP has been going on the opposite direction on Friday. So either that was just a one-shot thing and we're going to get to break the 1.12 area. If that happens, then I'll restore researching for bullishness into those assets. Until then, dollar remains subdued. The GBP/USD is freakingly strong, freakingly strong. That's the only thing that bringing gain on the account so far. The AUDNZD has been stopped last week, so yeah, I mean my entire gains just flushed away into AUDNZD. That's incredibly crazy. I've never seen such things, but anyway, that's how it is. The markets are a little crazy this year. I think everyone figured it out. It's not the easiest way. It's not the easiest year to deal with. USD/JPY might be facing a failure below resistance, but if not, then there is still higher resistance to get to test, which is the 110 area. But if we fail in here and break down a support, like that, this is likely, and if it happens, I think dollar might be something to look for, because if dollar was about to break down the support, like the NFP was just an ugly pullback, when we've got strong bearish pressures on the dollar, stronger bearish pressures, which I tend to believe we do, because it's the first time in a long time that we've got early bearish trending signals in here. Certainly not means that this will happen, but all I can tell is that we've got divergent bearish and bearish pressures on the momentum, which means normally we should break down the support. So how are we going to break down the support? I think we likely will, because technically speaking, we've got early signs that this is likely, or at least the most likely scenario. Is it going to happen though? It's complex, because nothing has to happen because technical suggests it. It's just in a probability way of thinking things, which is what I do, I would say likely going to go lower. But you know that the dollar is the center of the maze, and that obviously some people don't want to see the dollar going down because it will change their scenario. So the question is, are we going to have another dollar run because people just don't want to take further losses, or is it going to happen because it has to? I think technically speaking that's the most likely scenario, but let's face the reality. For the entire year, we had the same old problem. Wall Street refusing to lose gains and dollar refusing to lose strength. So is this another one of those times? I understand that some people have some reasonable doubts, myself included. I'm not buying this support, but I'm not certain it's going to fail. Technically, it should, but will it is another question. So I'm most likely indecisive at the moment, looking at market reactions. I'm not acting on this support area. I'm just waiting to see if it works out or not. So monitoring the dollar is the key element for the week to come. Monitoring volatility and other derivatives like gold and stuff like that, the junk bonds, is key to understand what's going to come over, because what we have right here right now is that the junk bonds are filling a gap, but bearish gap we had in here is a concern. So if we ever go down this area again, I think this is where things can start to go out of control and ripple out of control. Because in here, if the junk bonds are breaking a support, the next supportive area is at least there, and that's a significant pop into the credit risk regarding corporate debts, and especially risky corporate debt. Also adding to this, that remember that there is a shit ton of US companies, nearly 25 to 30% of companies in the S&P 500 who are nearly switching to junk bonds regarding their bonds quality. And if it ever happens, I mean, if the junk bonds bubble is showing a lot of new entries in terms of corporate being priced as junk bonds, this is a huge problem, because, like, remember, when you are a junk bond, the only thing that changes is how you're going to price for your interest rates when you go on to lend some money. It's simple as that. It means that you need some money to pay for your employees or your expenses or whatever, right? Like you need money. You don't have it because you're not profitable, which means you have to buy some money. You have to lend some money. And if you do it with an average corporate debt rate, you're going to be doing it for approximately 5 to 6% if you're closer to be a junk bond. If you become officially a junk bond, this number shifts on top of 10%. Immediately, just because you're priced in as a junk bond means you got some investors who nearly not going to give you $1, which means if you want those dollars, you're going to have to ask other type of investors, and these guys want higher returns, higher interest rates. And you're immediately shifting from 6% interest rate to 10% and above. And when you do this, it simply means lending $1 will cost you the double. And that's a huge problem because it's generally lending to bankruptcies in a further vision. So if we have more companies switching into the junk bond territory, that could spark some risk into the GNK index's asset. Remember that this is an index, all right? When you have a look at an asset, you must know what the fuck you're looking at. GNK is just the average lending rate indices on all the junk bond corporate debt. Simple as that. When it goes down, I mean the interest rates are going up for those companies. It's simple as that. So if we've got more companies in there, what is it going to show us? It's a problem because it could drive the overall interest rate lower, which could drive the GNK higher, but still the risk will be higher because more companies will be into big debt, but still that could lower the interest rate on the average basis of interest rates. So this is why you need to be cautious with GNK in the following weeks. It's not because GNK goes up that you have to figure out this to be as a bullish sign. It can go up because a lot more people are entering into this category. And if that's why we're going up, then that will be pretty much, I think, a bearish sign rather than the opposite. In the meantime, still have a look at the VIX and all its derivatives, like whatever the VIX is going to be doing next week is interesting. Look at the VVIX, which is the volatility implied on volatility itself. So if you see VVIX breaking some resistance, you might want to think twice. Because remember that the VVIX has been breaking a resistance and is holding higher support, which means if we go down to some resistance again, likely going to have a bullish breakout on volatility, which means volatility, end of the story. On the VXN, which is the 3 months expiration contracts, we've got a totally different picture. In here, we significantly broke to new lows. We made closer to, or no, we didn't. All right, no, we didn't. So we're dealing with a supportive area in here. Obviously, the 3 months expiration contracts, if they significantly and durably were to break lower, we'll have to break the lows of 2018 beginnings, which means if that is what's coming, breaking down those lows, like I said, we might have a first quarter of 2020 being significantly more bullish than people expect it to be, because we could have a significantly lowered volatility on assets. Okay, simply people having to use cover instead of selling their things. The usual stuff, buying puts instead of selling assets. It's the current motive, and we'll see if it's just keep on going this way. But in here, as you can see, on the 3 months expiration volatility, what I'd like to see is those contracts going up. If they don't, and if they keep on contracting, and if they break this support, I think we have to let it go. Probably for a couple more months. Like I said, the indicators will be free, so anyway, just take a pause. Have a look at weekly charts, settle down, stop trading for a little while, and wait for something reliable and low risk to happen. Whatever happens to the upside in the following weeks or month are so freakingly risky that if you get your hands down this corner, you're just going to end up fingers cut. That's the only thing I want you guys not to go down to. I stand on this. Not selling is the most rational thing to do right now, especially if you're a beginner. You just can't sell because it's a reverse trade and you don't do these things. The only assets you can sell right now are the German index, because we're still below historical highs and we're in a range trading area. You can sell the FTSE as well, you can sell the GPN, but you certainly can't sell SPX and NASDAQ and Dow Jones, which are making new historical highs, and therefore they're dealing with reversal trades. So you can't take the reversal on Wall Street You can only try to trade ranges in other parts of the world, waiting for what I said. Either the US bearish cycle will trigger, it will be the latest one, which means triggering the late but still triggering, or I'm wrong, it won't trigger at all and will set itself into an ugly bubble trying to make some gain with the somehow China recovery. But I doubt it's going to work this way, simply because that's the lesson life told me. And like I said, life taught me some lessons. That doesn't mean this will obviously imply and work in here. All I'm saying is that generally doesn't work that way. We generally don't have one area being just a gainer and the other ones, like this is not how things work. Things are cyclical. This is the reason why I tend to believe that US will have their downside, because it has to be that way. Like I said, it's totally subjective. These are things I think, but I certainly not trading those things unless I have positive context to deal with it. So I'm waiting for those weekly short signals, and if they end up showing up and then failing, then they'll fail. But this is the only trade I'm ready to do right now, waiting for weekly trades in Wall Street, and if they don't show up, I'm not trading. If they show up and get stopped out, I'll take the stop losses, and that's the end of the story. All right? If bubble is what's coming over in Wall Street, like I said, let it go. That's a bubble. And in that perspective, stop trading. You'll still have free indicators if you want to have a look at the market a little once in a while, but just step the fuck back. Just don't be part of the dumb trading. If you want to be among them, like I said, you can be right 99% of time, make a shit ton of money, of irrational money. Like I said, this is virtual things. A gain and a profit is there only when you took it, which means you can buy some stocks. You can think you're freakingly rich if for some reasons Apple's were to price $500 per share or whatever. You're really going to get a gain when you sell your shares. And if anything there just goes wrong, and if you end up selling, in panic selling, and if you more likely, even worse than that, can't sell because there's no buyers in front of you, then what's the problem? Yeah, you might have made a shit ton of hypothetical money, hypothetical gains, okay? Like on a day-to-day basis, you have a look at your trading account, everything's fine, you're making a lot of money. If all of this is meant to end in just one freaking day in which you end up broken, why the fuck did you do this? We're not there to bring you pleasure 99% of time to end up wrecked the remaining 1%. That's not how I teach you trading. I teach you survivability on a long-term basis. So don't try to make some easy gains for a few months to end up being totally broken a few months from now. The goal in here is to survive, make a little bit of low risk money when you can't pick it up. It's okay short term. If you want to do it short term, you can do it. All the problem is you make sure you're entirely liquid by the end of the day, because like I said, systematic problems are really surrounding the nearby areas, so you definitely don't want to be there if the shit hits the fan. Like I told you, it can be nothing. It can be things we expect. It can be things we don't expect. Just I'm giving you a few clues. Like imagine HSBC bankrupt. Like imagine the freakingly word fuck this would be the instant minute right after. So those things can happen. We know that this bank is really in a bad shape and is hiding a shit ton of OTC transactions that we don't know about, and not talking about the shadow banking. We're not even talking about the Deutsche Bank, which is literally bankrupt already, but we just don't want to say it. So there are lots of things that can turn bad. We just can't say that for sure. So far, Deutsche Bank's still there, HSBC is still there, so as long as things are not doing bad, you just can't anticipate it. All right? I hope this is clear. I can't stress those warnings enough. You need to be rational with your trading right now. The only way to trade is a reversal if you're selling, and it can't be done if you're not experienced enough. That being said, I'm going to leave you guys with that. So having a look at volatility derivatives for the weeks to come, likely going to be an interesting week if the technicals are respected, because normally we should have an inside ball week, which means totally boring. But just have a look at the market catalysts. Put some alerts on volatility. That's basically what I'm doing myself. On short-term volatility, like most likely 15 minutes, like you're rapidly going to see the areas. Like if we're bullish on volatility, then then we already had the two sets of waves to the downside, and normally we should head toward a resistance. So now what I do is that I just put an alert in there. If we get to the resistant context in volatility, means that we can have an interesting buying signal on volatility right after. Like until then, whatever happens in this area is none of my fucking concern. All I care about is, do we get to resistant context, and if so, do we reverse it? If we reverse the resistant context, you know what I'm going to be doing. I'm definitely going to catch the bullish trade on the bullish resist support context that may be following later this week, probably tomorrow or right after. All right? That's the only thing I'm going to be doing this week. All right? Waiting for interesting context to show up. If nothing happens in there and if we start selling again, this will be overlapping resistance, and we're likely going to have another bearish sets of weeks after, breaking the new lows, low volatility and stuff like that. And if that's the case, the week will be freakingly boring. Okay? So just have a look at volatility right now, because that's all we're dealing with. It's all about that, period. All we care is volatility. The market doesn't nearly give a shit about asset pricing. The market doesn't nearly give a shit about macroeconomic projections or whatever. We're just dealing at whatever we should do with short-term risk management and volatility. So look at the news flow, look at how volatility reacts to the news flow, and wait for volatility boundaries. So let's sum up the information. Have a look at VIX. Deal with Bollinger Bands instead of trend channels if you're dealing with SPX and traded assets. All right, because we're going to look for volatility more than trend channels or whatever that is. So look for volatility boundaries if you're trading in the short term. Look for VIX behavior in the meantime. And that's it. Have a look at the dollar in the background scenario, but certainly don't take any fucking trade in the nearby area, because this support is really tricky to buy. There's no buying signal and there are bearish pressures over the latest resistances. So normally bearish pressures on the dollar, but you can't take the breakout until it happened. So look out for a potential bearish breakout on the dollar. If you want to take it on short-term time frames, I think it's okay, but still very risky, but because the market doesn't want it to happen. We've said it's clear all over the year. The dollar doesn't want to break a single support. So if we're holding that support, I wouldn't necessarily be surprised, even though technicals suggest it should fail. So buying dollar is out of context, all right? Selling it can only be done with a breakout trade, and it's very complicated because the plunge protection team doesn't want that to happen, and they will do anything to prevent that from happening. The stock market doesn't want to break any support, and what's been done last week sincerely suggests we're likely going to stay there on the best case scenario for bears. So don't expect much bearishness right now unless something goes totally out of control, and in that perspective we have to break resistances on volatility, which means we have to get there and keep on going higher until we get to the previous 17 area of resistance in the VIX. There's really nothing to worry about. It's just, all right, the bulls are not worried, and as they're not worried, they do nothing. They're certainly not selling their stocks, which means no selling demand, still the same old bullish background with liquidity injections, putting prices higher, share buybacks, and all those background bullish stuff. So as long as there are no bears, prices will keep on going up. And you have to understand that. It's a fundamental reason in asset pricing that drives asset valuations higher right now. It's totally stupid because it's a short-term vision of stuff, but still that's what drives asset prices movement recently. As the bears are not showing up, we have a literally bullish background setting itself in the meantime, and that's just bringing volatility down until something fucks up this beautiful mess. All right? Until then, waiting for it is the only choice you have. Bye guys, trade safe, and have a look at this area for the VIX. That's the one we're currently trading, by the way. So have a look at how this reacts later today. I'll have a look at the Wall Street session today, but no more than that. All right, just having a look. Certainly not acting today. I don't think there's nothing to do.